Welcome to another episode of Millennial Investing Explained. Here's today's question. Compounding is likely the most powerful thing a millennial investor has on their side. Albert Einstein once said that compound interest is the eighth wonder of the world, and I completely agree with that. It is so powerful, especially for those with many years to really let it work for them, like millennials do. It's so important to get started early so that you can let your money compound for you as long as possible. And I know this is simple, but once that time is lost, it's gone forever. You can't get it back. You're not going to be able to go back in time and invest. And a lot of people, a lot of successful investors, one of their biggest mistakes or their biggest regrets is that they didn't start sooner. So get started as early as you can. And so what exactly is compounding? Compounding is just the idea of you earning interest or profits off your previously received interest or profits. So for example, if you had, say, $10,000 in a savings account that pays a 10% interest rate, you'd receive $1,000 in interest after 1 year. But then in the second year, you'll receive 10% on your new balance of $11,000, which includes your $1,000 of interest from the previous year. So now instead of earning just $1,000 in interest on the $10,000, now you're earning $1,100 on the $11,000 that you had in your account. So then in the next year, instead of earning interest on just $12,000, you'll earn it on $12,100, and so on. And I know this doesn't really sound like a lot of money when you hear it like this, so I'm going to give an even more drastic example from moneyunder30.com. And I'll be sure to put links to other examples and illustrations in our show notes so that you can really see the true power of compounding. So the Money Under 30 example goes like this. There were 3 people, Michael, Jennifer, and Sam. Michael saved $1,000 per month from the time he turned 25 until he turned 35. Then he stopped saving, but left his money in his investment account where it continued to accrue at a 7% rate until he retired at age 65. And then there was Jennifer, who held off a little bit and didn't start saving until 35. She still put away the same $1,000 per month from her 35th birthday until her 45th birthday. Like Michael, she left the balance in her investment account where it continued to accrue at the same rate of 7% interest until age 65. And then lastly, there was Sam. Sam didn't get around to starting to invest until 45. Still, he invested the same $1,000 per month for 10 years and then stopping his savings at 55. Still, he invested the same $1,000 per month for 10 years. He also left his money to accrue at a 7% interest rate until his 65th birthday. Now, their situation seems similar. They all put $1,000 away per month for 10 years, but the big difference is the amount of time that they let it compound and the time in which they started. The earlier people had longer for their money to compound. So despite them all saving the same $120,000, their ending balances at their retirement was very different. Michael had over $1.44 million, while Jennifer had about $730,000 and Sam had about $373,000. Now, I know these balances still sound like a lot in comparison to $120,000 they put in. So of course, $120,000 to $373,000 is still a lot of money, and that still shows why you should invest. But if you look at Michael's, he turned the same $120,000 into $1.44 million. And that right there is the power of compounding.
So I'm ashamed to say that I knew about the power of compounding, but I still feel I was late to the party. I was in my mid-20s whenever I was done with college. I got my first job, I paid off my student debt, and then I started compounding. But compared to you, that's old, right?
Yeah, I was very lucky. I can't take too much credit. It was just myself being in the right place at the right time. But basically what happened was when I graduated from high school, I got a job at a local credit union. And part of their orientation and training program was that they required a financial education course. And in the course, they taught me why it is so important to start investing early. They talked about what compound interest is, and they showed about how it impacts investment returns over the long term. And for me, being young, it really made a big difference to me seeing how at just 18, I could have a huge difference in my retirement if I just started now. So I really took everything they taught me to heart, and I started to invest for retirement at 18. And I know that sounds kind of crazy because at 18, who's thinking about retirement at 65, right? But when you learn about compound interest and see how powerful it is, it's hard to not take advantage of it at that age. So, and fast forward to today, I'm very thankful that I had that course and that I got started as early as I did. That's all for this episode of Millennial Investing Explained. Be sure to follow me on Instagram, Twitter, and Facebook, or subscribe to our YouTube channel to get even more free content.